Hi, everyone. Welcome to our webinar titled The IRS Strikes Back. Be ready to defend your ERC claim. My name is Ahron Golding. I am a tax lawyer here at Roth&Co. My specialty is tax controversy, which means I help people resolve problems with the taxing authorities or the IRS so that they could sleep at night. Today's topic is something which is very near and dear to my heart. So let's dive right in. We've been hearing a lot about that the IRS is coming and they are going to enforce all different kinds of abuses and fraud that they believe has occurred regarding the employee retention credit, part of the COVID law, and the CARES Act, and the IRS is here. So what I'd like to do in this short presentation is to give everybody an idea of what it is that's been going on in our offices, in the conversations that we've been having with the IRS, the audits that we've been handling, and what we've been hearing from the industry. So just to start off, I'll tell you what we will be discussing in this webinar and what we won't be discussing in this webinar. And I apologize for those things that we won't be discussing. That might be some of the stuff that people are interested in, but it's beyond the scope of what we're going to be discussing. We are going to be discussing things that are of practical interest to business owners which already took the ERC. So there's all kinds of practical questions, getting your ducks in a row to be able to defend your ERC claim, whether you got an IRS notice already or not, what the IRS is looking at, that type of stuff, and deciding whether to participate in the IRS's voluntary disclosure or withdrawal programs that we'll talk more about. And we're going to focus on the civil side. We're not going to focus on the criminal side of things. If somebody here created a company and took the ERC claim where there were no employees and no wages paid and just took the money and went to Tahiti, they're probably not watching this webinar. If they are, I would just advise you to look up a good tax controversy attorney and have a discussion with them. But we're going to be focused. What we're not going to cover in this session is going to be, where's my money? I've been hearing that from a lot of different businesses. There are people that are relying on it, and there are many of them that really deserve that ERC money. And it's really what Congress intended for people to retain their employees and keep in business when they had a really bad revenue drop, or they had something where they were subject to some type of closure. And these businesses very often are waiting for 2+ years for their money. We're not going to be discussing that in this webinar. We have in previous webinars. I will just mention at the start something that we have experience with, which is sometimes people want to get tax advocate service, TAS, which they are a phenomenal group of people. They are officially independent from the IRS, and they could actually help get an amended return process to get an ERC claim. Just be aware that we have seen situations where going to tax advocate service and them pressing has led to being selected for audit. Now, if somebody has no problem with that and they say, bring it on, then by all means, go to TAS. You might be able to do that. But I just wanted to say that word of caution. Other things we're not going to be discussing today are going to be, how do I calculate the credit? We spoke about that on prior webinars, and there's all kinds of information about that available online. And we're not going to be speaking about the legislation which Congress has passed, where that is, what are chances it's going to be passed. All I will say in passing before we get started is that you could tell from the type of legislation where the IRS's mindset is and where Congress is in terms of things that the IRS is begging Congress to please stop the applications for ERC coming. They feel choked by it and they can't continue. And, you know, it might very well have ended already the receipt of applications. We're not going to speak about that. The IRS is certainly trying to have increased time to be able to audit so that we'll have business for a while, you know, in terms of having a longer statute of limitations to be able to audit these ERC claims for 5 years rather than the shorter amount of time that they usually have to do. And they also want the increased penalties for taking ERC credits and for the promoters. We're going to speak a lot about promoters in a little bit. But the IRS is asking for Congress to make it illegal to take a percentage of an ERC claim to try to weed out these ERC promoters. So what I'd like to do is jump right in to talk about what we are seeing in the audits, in the ERC audits. It took a while for the auditors to get trained specifically in ERC. They have them trained, they have units, and they're rolling out audits by the day. And, you know, so I'm just telling you what it is that we've been seeing in our office in terms of there is a focus on healthcare. Some of auditors have told me that. So there is a feeling at the IRS that, you know, we know that healthcare provided a great service during COVID, and, you know, certain healthcare agencies were essential businesses. And therefore, if, you know, the IRS feels that if they really were operating and were doing fine financially, were they really shut down? Was that truly a sweet spot to be able to receive a lot of money in ERC? And they've been auditing them. So what I'd like to do is talk about what the IRS refers to as the suspicious 7. These are the things that the IRS calls their red flags. What they think that if somebody sees any of these things, they should think twice about taking the ERC. And by looking through these 7 fairly quickly, I'll just give my comments in terms of what we're seeing on audit. So again, none of these necessarily mean that because there's this red flag that they don't, they're not eligible for the credit. But these are what the IRS refers to as the suspicious 7. Number 1 is too many quarters claimed. The IRS looks and they see, did this person really qualify for the last 3 quarters of 2020 and all 3 quarters of 21? Were they really shut down, or did they have the gross receipts drop for all of those quarters? That is something that is just a red flag the IRS is looking at to see if that was true. Number 2 on the IRS red flags list is government orders that don't qualify. This is something that I would probably say takes most of our time, both on audit and in consultations with taxpayers. They want to know what type of government orders qualify. In the industry, they refer to it as a partial shutdown or a more than nominal modification of your business operations that would make somebody eligible. So I'll just tell you a conversation that I had with a colleague of mine. His name is Moshe Geltuch. He's a partner at Roth&Co, and he runs our department. And when the ERC came out, we had many discussions in terms of who qualifies, what's considered the partial closure. And Moshe Geltuch opined that the IRS is probably not going to allow eligibility of ERC claim based on a partial shutdown if there is no monetary loss at all. Moshe is an accountant. He's a forensic accountant. And he says that, if the goal of the ERC was to prop up companies when things weren't doing so well, the IRS, now the way the IRS is not going to allow something that didn't show any monetary impact, negative monetary impact on the company. And the way the law is written, it's either a gross receipts drop of a certain amount, or it's a shutdown or partial shutdown. Doesn't necessarily say that you need both. Well, I'm here to say today that my colleague was right, and what the IRS is saying is that we're going to only recognize a partial shutdown as a modification that created a difference in your business that makes you eligible for ERC. If we see a monetary loss, they like to see a 10% drop in revenue or in a revenue stream from a particular type of business. But if you have a situation where revenue actually went up and you've been relying on this argument that I could have made a lot more if there wasn't this order, or the order did not create any type of deficiency monetarily, just know the IRS is looking askance at those and really is saying, show me the money. Let's see where there is some type of revenue drop. They are allowing even, you don't need the full drop in gross receipts like the 50% for the 2020 credit or the 20% for the 2021 credit. Even if there's a 10% drop, but that shows that the government order, which still has to be a real government order, that actually created a more than nominal modification. The government wants to see something like a more than 10% drop. So very often the numbers are going to make a big difference. They're also focusing on the IRS was there an order for the government? Was there an order on the business that the business has to shut down? Very often people like to make the arguments that they're eligible for ERC because their customer was under some type of order, which then created an effect on them. And if you're familiar with the frequently asked questions, you're probably familiar with the auto repair shop that wasn't able to, because they couldn't get supplies, they weren't able to be open. That's considered a government order that affected the business directly, but it has to be a government order on the business. So that's what it is that the IRS is looking for. The other thing which we're seeing often is, I think, when people get a little bit aggressive and they say that there is a partial shutdown, which means that there's a segment of my business which the IRS says is fine to be considered a shutdown if a portion of my business is shut down. But when people take that to an extreme and the segment of my business is partially shut down, so therefore it's actually like 1% of my business, when you really take a look at it, those are things that the IRS is having real trouble with. So again, those are things you'd want to speak to a professional, somebody who is dealing with these matters constantly. But that's sort of a lot of the stuff that we've been seeing. Next on the IRS's red flag list is when there's too many employees and wrong calculations. That is something where it's simply going to be easy for the IRS to select on audit. If somebody, let's say, took the 2020 credit and they're showing 300 employees, which is more than the 100, or for the 21 credit, you're filing a 941X showing 1,000 employees, that's probably going to get selected for audit. It doesn't mean it's fatal to your ERC claim, but due to the specific laws of if you're considered a large employer for that particular credit, you're only able to take the credit for, even if you had a shutdown and a drop in gross receipts, you're only able to take the credit for those employees that you were paying for not working during that time. So that's just something to be aware of that the IRS is looking at. The IRS is looking at to see if you double dipped with PPP. If you took PPP, did you also, did you back that out? Did you make sure not to double dip on the credit? That's if you got PPP forgiveness. The businesses that are citing supply chain issues. This is something that the IRS loves to hate. The IRS does not like this supply chain thing because it's sort of got out of hand. We were speaking before about the auto repair shop example. The chief counsel, which is the IRS law firm, came out with a memo talking about different examples of supply chain issues that do not create eligibility for ERC. So just saying that, we had supply chain issues just like everybody else, and therefore we're eligible for ERC, that is almost certainly not going to fly. It has to be very specific and clear as to exactly what happened, what government order was affecting your business. And it has to be a government order, not government guidance or recommendation. So that is something that the IRS has clarified. If if a business claimed the ERC for too much of a tax period, again, we're not seeing this that often, but a business has to know that when they are claiming that they're eligible because of shutdown, it's only for that period that the government order was actually in effect, not for that entire quarter. So that's just something to be aware of when you are getting your file ready to defend your ERC claim. And the other two are really not that relevant. Like we said before, if a business didn't pay wages or didn't exist during that period, that's just clear fraud. And if the promoter says there's nothing to lose, the IRS says, no, there is something to lose because there are penalties and interest that the business will have to pay back. So just to speak a little bit about this ERC promoters that the IRS is really going after. The IRS really believes, and they use harsh words for these ERC promoters, if the IRS is auditing a company and the first question that they ask is, I'm talking about the IRS, they will ask, who did you use to help you get the ERC claim? Because the auditors are told from their managers, find out who told them that they're eligible? Was it an ERC mill or ERC promoter who made these wildly aggressive arguments, scams, unscrupulous? They use words like that, that the IRS wants you to go to a trusted tax professional. If the answer to the question of who did you use, and the answer is a company that just popped up, in order to get people ERCs, and they took a percentage of the credit, it's there's a strike against you right away, because the IRS is just gonna be skeptical of such a claim. Now, I will tell you, there are different ERC mills or promoters, if you will, or tax credit firms that I have seen in the past few years. Every single one of them tries to distinguish themselves, and they say, we're not an ERC mill, we're the real deal. We give you attorney letters, we really see that you're eligible. Some are better than others. In my experience, very often these ERC companies, if you have to make a claim, you're considering making a claim and using them, they're very responsive. If a taxpayer gets an audit letter, they haven't been that responsive to that. Sometimes they are, but I haven't found that. So just be wary and look for a trusted tax professional if somebody gets an audit letter. Some places where we've seen some errors that people made, one is a big one. It's not on the IRS 7, but it's with regards to aggregation. Aggregation is something that is very complicated. Everything related to ERC is complicated. There are laws as to what determines when a company is aggregated. They have similar ownership with other companies, and it makes a very big difference for whether you're eligible for the ERC. Companies simply took the money and then asked questions later. In certain circumstances, just look to see whether you followed all the laws in terms of the aggregation and its effect on employee count, on revenue, on shutdown, whatever it is. Just when you're doing your review, take aggregation into account. And also, just simple calculations in terms of PPP or not capping the 2020 credit per quarter. The 2020 credit had a cap of a $5,000 credit for each employee for the entire year. Some businesses just, weren't aware of that, and they did like what is in the 2021 credit, that you could renew it every single quarter. I apologize if that's too granular, but that's something that whoever it is that calculated the credit, just double check with them to make sure, if they relied on partial suspension, just understand what it is that you relied on, so you can make a determination of the voluntary disclosure. I will say the IRS actually does a good job on their website. There is a checklist and a flow chart of eligibility. If you have eligibility due to shutdown, go here. Did you have this? Did you have that? They're pretty good, and that's pretty much where the IRS stands. I don't know what's going to happen in litigation to know if there's going to be a greater allowance on partial shutdown for the ERC. But it seems in the past few months, everything has becoming more and more restrictive for the non-taxpayer friendly, if you will. So I'll discuss quickly 2 disclosure programs. One is a voluntary disclosure program that it's actually an interesting deal. the IRS is saying, if you received the credit already, in other words, you received the money and you cashed the check, then you are eligible to apply for this voluntary disclosure. This has a deadline of March 22nd. This is the reason why we rushed out this webinar, to give people an opportunity to be able to look into this. By March 22nd, they would have to apply for this voluntary disclosure. The IRS is giving a deal, which basically says you only have to pay back 80% of the credit. If you are basically saying, hey, we know we weren't eligible, we thought we were eligible, now we believe we weren't eligible, we'll give you back 80%. You keep the other 20%. Officially, the 20% is to pay for the expenses of the fact that you probably had to pay an ERC mill a certain percentage of the ERC claim. But regardless, that's the amount that they are offering. No penalties, no interest, and they won't audit you for those years. That is just something that, you know, if it doesn't prevent criminal liability, but again, we're not talking about actual fraud here. We're just talking about honest mistakes. If somebody thinks that they were not eligible, the IRS, in order to give you this deal, they are basically going to want you to squeal on the ERC mill that told you that you could take the credit. That doesn't necessarily mean anybody did anything wrong, but they're going to want that information. You're going to have to comply with their request for information. So that's just an interesting program that's out there. There's another program, which is the IRS withdrawal, ERC withdrawal program. That is for people that haven't received the check yet. So in other words, if you haven't received the money yet, you're still waiting. That doesn't mean you get to get this 20% discount. That's only if you already cashed the check. If you did not receive the money, you didn't cash the check yet, then you are eligible to participate in this withdrawal program. And it basically says, sorry, I didn't mean that. And they will then consider it as if you never filed the 941 at all, which again would mean no penalties and interest. That's pretty much those two programs. I'll just quickly end off talking about these opinion letters. There are opinion letters and there are opinion letters. The bottom line is it doesn't really make a difference who signed it or how many words are on the opinion letter. The main difference that we've been seeing in IRS audits is what is the numbers show? What is the backup? Very often the opinion letters, a good opinion letter, will show how there was an effect of more than nominal amount on the business and show it actually in numbers. That's really what it's going to depend on, whether the opinion letter is going to mean something or not. It would also help in the event of a penalty being asserted that having gotten an opinion letter certainly helps to show that I did not intend to defraud or in any way I was trying to do the right thing. Anyway, thank you very, very much for listening.